Isn't it everyone's favorite? Tax time again, and if you're like most of us, you want to minimize the amount of money that goes into the tax man's pocket. So one way to do that is to make sure you're taking advantage of all of the breaks that you're entitled to. So here to remind us of some of those things that you might want to use to ramp up your return is Leo Kelly of Kelly and Creaghan Chartered Accountants. Good morning to you.
Good morning.
Okay, is this like Christmas for you? Tax time?
It's more like Halloween sometimes.
It can be like Halloween, but we want to make things less scary. So you've outlined some points that people can look for where you can actually catch a break. Let's roll through as many as we can. So let's start with childcare expenses.
Well, childcare expenses are a deduction for parents for children in daycare, but just not daycare. There's other things that extend beyond that. For example, after school services, even possibly boarding camps, overnight, horse riding camps, hockey camps, those sort of things. So a child between up under 7 years old, $7,000 per child deduction. Also, if they're over 7, under 17, $4,000 per child, sort of thing. So it's a very good deduction sort of thing. Of course, with everything else in tax, there's always some limitations.
Right.
So you have to have the person with the lowest income deducting the child care expenses. So sometimes there's a catch there, sort of thing.
There's always a catch.
There's always a catch, yeah. Read the fine print.
Read the fine print. Those things can certainly add up, though, too. So hockey camps and other extracurricular activities, make sure to keep an eye out for those. Tuition credits. Tuition
credits, probably one of the biggest things we see with tuition credits is the missed opportunity of transferring the unused credit to a parent. Students at post-secondary institutions can deduct their tuition, also a specific allowance for the number of months they're in full or part-time attendance at university. If they can't use all that deduction because their income is lower, just for part-time work, whatever, they can transfer the unused tuition up to $5,000 to a parent or even a grandparent. Thing.
Oh, is that right?
Yes. And if they don't utilize all that, they can still carry it forward into the future and use it at a future date, sort of thing.
Okay, one to put in the bank. Okay, now this is something you say probably one of the most missed items, and those are medical expenses.
Medical expenses, why they're missed so much is the definition of medical expenses is so broad, type of thing, and it even varies from province to province, sort of thing.
Right.
We think of things like prescriptions and eyeglasses and dental as medical expenses, but there's also other type of things. For example, people with company plans. The plan may pay, say, 80% of the plan.
Right.
The other 20% is still a medical expense, so don't forget about that. Also, people traveling, if they're buying medical insurance for a holiday, those premiums, again, are medical expense. Snowbirds going south for winter often pay large amounts of insurance to go south, and for medical reasons, again, that's a medical expense. Yeah. And also, in isolated case, there may be like modifications you have to make to a home. It's a person with a wheelchair, other disabilities, again, those are qualified medical expenses, sort of thing.
Oh, so tack those on. Okay,
Yes.
that's a great tip there. How about children's fitness programs?
Children's fitness programs is a relatively new program, and basically we call it anything that makes somebody sweat. It's an athletic type program. It could be things like ringette, hockey, gymnastics, dance, any of those type of activities where they're involved in a physical activity. It's a $500 tax credit. However, in 2014 is actually rising from $500 to $1,000.
Wow.
So people need to be aware of that. And just because they have $500 in expenses, they shouldn't stop there if they have children in multiple programs, I think.
Right. Okay. So if you've got your child enrolled in a dance program and that costs you $700,
yes,
then all of that can
all
go.
of that is now an eligible credit, as we call it.
Okay. Excellent. How about moving costs?
Moving costs is probably the one area that Revenue Canada is going to send you a letter on. If you have moving costs more than several $1,000s, they're going to audit you, almost guaranteed, sort of thing. But moving costs can be pretty significant. If you move from your existing location to a new work location and it's more than 40 kilometers, that's a moving cost. So, for example, somebody moved from Edmonton down to Calgary, that would be a qualified moving cost. If you're already living in Calgary and you decided that you want to live out in the country and you're more than 40 kilometers away, that's not moving costs. That's just a lifestyle change, sort of thing. Big things involved in moving would be real estate commission on your house, storage of your furniture, transportation of your family to a new work location, and up to 15 days accommodations and meals for the family while you're temporarily in transit, sort of thing. It's a big item type of thing. Yeah.
Okay.
And the moving costs can only be deducted against the income in the new location. So if you moved late in the year, say December, and you earned $5,000, but your moving costs were 12, then you're only going to deduct $5,000, but the balance you can deduct in the following year.
Okay, great tips. We're out of time. We got to a lot of them. Where can people find you for more information?
We're at Kelly and Creaghan Chartered Accountants, and we're at 1000 Center Street North.
All right. Thank you so much, Leo, for
You're
sharing
welcome.
those tips with us this morning. Happy tax season to you.
Thank you.
And happy tax season to you.